Welcome to the daily update, where I'll go over the action in the market for Wednesday, July 17th, and then we'll see how things look for Thursday, July 18th. Incidentally, for those of you that are members in the program, I'm recording this a number of hours before I usually record. I have an obligation during my usual recording time, and so I wanted to get this done and posted as soon as possible. I'll also be uploading the trade ideas and daily journal just as soon as I get a chance to take care of that, but it might be a little bit later than usual. For those of you that wait until after the market closes, everything I just said really doesn't apply to you. I do have a program called the SPXInvesting Program. The members I were referring to, those are people that are in the program right now. It's currently free. It's currently wide open. You're more than welcome to take a look at this and see if it's something that's of interest to you. There are links below this video and every video that I post that take you to the website. There's also links available to go through some other videos that talks more about the program. If you want to contact me, here is an email address where you can do that. Also, I post a number of videos each week. All of them tie into the daily video update. All the other videos I consider to be supplemental videos. Let's go back and talk about what happened. Man, we had a pretty significant down day and really just kept going. We were finally able to find some support, but there was news coming out that was pretty threatening to the mega caps and specifically the semiconductors. And the futures were negative. We were down about 1% before we even opened. And that just carried over into the cash session. There were some feeble attempts for buying to come in. We played around with the 5,600 level and kind of battled around that. We're still positive for right now, believe it or not. But we'll go through the charts. And at this point, anyway, it still looks like a pullback. Now, this could develop into more of a decline. And if we get down to the 10% area, that's more of a correction. We can only go with what we're seeing right now. But we did really have a big gap lower, more than what we've seen in quite a while now. We gapped below S1 at 56.48, below S2 at 56.28. Prices fell down to S3 at 55.97. So we broke below that 5,600 level. And we battled above and below the 5,600 level pretty much for the rest of the day. And we closed almost at the intraday low. We were down 1.39%. May not seem like that much on a percentage basis, but compared to what we have been seeing lately, this was a pretty significant move. We were above average with volume. Now, in the short, intermediate, and long term, we're still positive. We're working a lot of these extreme positive conditions right now, where you could say overbought. We're also coming out of a period of positive seasonality. Is that going to matter? There are still lots of positive things that we can point to, but at the same time, I think the market was feeling a little bit too taken for granted, and everybody was piling into small caps, mid caps, and they actually started out the day looking positive because now that's the thing to do, and people are starting to do it. But where we really saw things taken lower was with the mega caps and the semiconductors. It's still about inflation and interest rates, but that really didn't play out in Wednesday's session, and then all the different geopolitical events. Some comments: the Dow was actually positive. Johnson & Johnson came out with earnings, and it was the only index to actually close positive on the day, while everything else ended up being down. The semiconductors led stocks lower. This was in reaction to a Bloomberg report that there's a concern about some increased tightening of export restrictions to China. And the market just decided to use that as an excuse to induce some selling that then carried over into the cash session on Wednesday. But the bank stocks, they're still looking pretty good right now. You notice here, if you've been watching these videos, our short-term list, it's shorter than it has been. We're still looking pretty extreme with the ADX itself, even though the green line on both the short-term and intermediate-term charts is going down still. We're still extreme with the 20-period exponential moving average, and then the 20-period that we use to measure stocks inside of the S&P, it's still extreme, so that's still holding up for right now. And then our stochastics charts are extreme positive. We do have one extreme negative reading. I mentioned in yesterday's video, where's the Stochk RSI these days? Well, it showed up right here. It's already extreme negative. Intermediate term, a much shorter list than what we were seeing before. We have the ADX on there because it's giving us a very high reading. I could have taken the accumulation distribution off. We've actually dropped below that extreme positive reading. The S&P McClellan oscillator, it's holding up fairly well. Didn't see a really big decline there. It came down a bit. And then the Swenlin trading oscillator based on price. We're lagging a little bit right now based on volume. And we're already extreme with the VIX based on the RSI 9, just to show that we went down pretty far, pretty fast. Then on a long-term basis, we're still looking extreme positive with the 150 and the 200 period moving averages. So you can see there's a mix. We have a few oversold indications already. There's still some overbought indications, but the lists are much shorter. We haven't really changed with the scenario here. It does look like the market's pretty much counting on there being a rate cut in September. The dollar was down and interest rates were down, and yet stocks still declined, at least at the mega cap level. We closed at 4.15% for the 10-year yield, where we had been at 4.17%. We're still inverted with the yield curves, and sentiment did tick down. We came in at 54. We're back over to neutral, where we had been positive at 64. And we are still in a trend with the ADX, but with the down day, we are now negative. And for the moment anyway, I'm keeping the momentum at mixed. We saw a pretty significant downward move compared to what we have been seeing. Now, we could easily shift back and look more positive. We haven't done a lot of technical damage to this point, but until that gets figured out, I'm more or less mixed with the momentum. And that just measures what have we done in the last 2, 3, 4, 5 days when you take that all together. We did get the weekly MBA mortgage applications index. It came in at 3.9%. Last time it was down 0.2%. Housing starts at 1.353 million, a little bit more than the 1.31 million they had expected, and also up from the 1.314 million we saw last time. Building permits, again, another leading indicator here, came in higher than expected at 1.446 million and up from the 1.399 million we saw last time. Industrial production came in up 0.6%, much more than the 0.3% they had expected, but down from the 0.9% we saw last time. Capacity utilization, we're still under that 80% level, coming in at 78.8. They expected 78.6, and we're up from the 78.3 that we saw last time. So here are some charts. The weekly chart of the mortgage applications did show a nice little bump up after we had seen a couple of weeks of negative action there. Here's the housing starts and building permits, and then they take a 3-month average of that. Well, we're ticking up a little bit here with the blue line with the housing starts, and we're still declining overall with the building permits. And these are the things that you have to do first before you build a house, of course. And so that's why they tend to look at these as leading indicators. Here is the housing starts showing a little bit of a tick up from the previous reading. Looking at production and capacity on a year-over-year basis, production is going up and utilization is actually coming down a little bit. And then capacity utilization here, getting up a little bit below this 80 level still. Typically what happens when we get up above 80, that means we're at full capacity at that point. The factories and all the different things that are used to produce things, they're pretty much, they can't handle any more than what they're handling. And then on a month-over-month basis, we were positive with industrial production, but it was down from the previous month. Some Isabel Net blog charts. Here is the active asset managers. And I point this out every time we deal with a chart like this. These are professional money managers, but they're also human beings. They also have peer pressure. They have client pressure. They have their own pressure that they put on themselves. They're all trying to beat, especially the S&P 500. And so they're getting a little too exuberant here. Now, we did get a lower reading in the latest reading that I went out over the weekend, but it's still at a pretty high level currently. And a lot of times these folks are very good at buying tops because they're chasing things too, just like a lot of individual investors do. Here's the cup and handle. This, again, this is before Wednesday's session. So Maybe the handle's a little bit broken right now. I don't use a lot of this type of methods when I do technical analysis, but I still like to point them out. This is a weekly chart, long-term chart of the S&P, and we are looking pretty good here. We came up to this 5,600 level, or it's really hard. Yeah, that's 5,600, and now we've dropped down below it. So this chart must be a little bit old at this point. And then some different support levels, which we haven't even come close to hitting yet. And then the cash levels, they rise to 4.1% from 4%. That just means folks getting a little bit nervous about what's going on in the market. So they're taking money out of the stock market and putting it back into the money markets. The sector funds, we still have the tech sector. That's where we see most of the money going these days. And then large cap versus small cap, we're seeing this starting to show a little bit of a change. Now, the Russell 1000, those are the large caps, and they've been really outperforming over the long term now. We could be starting to see a shift, and that shift is still continuing even after Wednesday's decline for the Russell 2000, which are the small caps. And then looking at the expectations for a recession in the next 12 months is starting to drop down. It's still getting kind of a high reading, but when we look at the context of this, it has been declining lately. And then the advanced real retail and food services sales. Real just means they take inflation into account. This is one thing that we've been watching, where when we go up, that's really healthy for the economy. But when we start to level off, you notice that a lot of times we level off right before we go into a recession. I'm not saying that's what's going to happen, but that is a characteristic of what has happened before. I didn't find anything on Twitter, and I'm kind of trying to put this together a little bit quicker these days. So, all right, so here is a pretty scary looking intraday chart. And if you follow some of the other videos that I post on the website, I was having some real concerns. Even though we were still looking positive, I was seeing some under the surface weakness, especially with our smart money indicators. And it just kind of, I didn't fill any positions on Monday or Tuesday. I got out of some positions that were open on Friday because we started to get back some gains. I didn't open anything new. There should be a Wednesday right here. For some reason, that didn't get copied over. But we saw a pretty significant decline down compared to what we've seen before. We came right down to S3. That tried to hold as a support level, and that was right around that 5,600 level. Excuse me. And then we dropped below that, but we didn't really pick up steam. However, on an intraday basis, once we dropped below this level of support, this now became resistance. And we were not really able to get back above that, even after trying a few times. And we closed pretty much at the low. Now, we set the low earlier in the day, but we came down and matched that low as we went into the close. There's our intraday chart. The futures were weak. You can see right here when we went from the initial overnight session to when things started to open up in Asia and then in Europe, that's when we started to see things really drop off, and that just carried through into the cash session. I'm seeing a little bit of a bounce in the initial overnight session currently. And we are starting to see where value, the red line, is going above the blue line, which is growth. Growth really took a hit in Wednesday's session. Here's our intraday chart. We're just really coming down with our growth to value ratio for the S&P on the intraday chart. And we were down, see where value was actually up. Growth was down just massively. Growth was down more with the mid caps, and it was also down where small cap value ended up being up. So we're seeing a real drop off with our growth to value ratio with the small caps, with the mid caps, and the S&P 500. Also, when we look at the ETFs, growth versus value, we're dropping further into the rainbow now. And we were seeing a nice little improvement here with our discretionary to staples ratio, but we pulled back on Wednesday. Large cap growth, after setting a recent all-time high, is pulling back, but notice how we're still above the 50-day moving average. And the Russell 1000, the large caps, and we do a ratio with the small caps. This continues to decline as the small caps are outperforming. They were down. They ended up being down. They were positive right after the open, but they just couldn't hang on to that. But they were down less than the large caps. The Wilshire, after just setting an all-time high, was down 1.42%. Here's our trend, and this is what has been a little bit concerning. We're going up with the ADX and the green line's on top. But even when we've been having up days, the green line has been coming down. That's one warning sign that I was picking out. On the short-term basis, we're also starting to roll over and could be dropping below the moving average here. That means we're seeing a weakening trend. Now, as long as even if we're coming down, if we're still above 40, actually, if we're still above 20, we still consider that to be a trending environment, but it's possibly a weakening trending environment. We did spike up a bit there with volume. You can't really say this caught people off guard. If you were watching the charts like we've been doing, this was not necessarily a surprise. We're never quite sure how it's going to play out, but it's like things seem to be coming together to the market needed a cold splash of water because it just seemed like people were just throwing money at the market and it was magically going up. We are coming in, and we're in right now, the period in July and August where we see volume drop off with the NYSE as well as the NASDAQ, and that will continue through August. Looking at sentiment, not a real big change with the Ulcer Index. We did get the latest reading from Investors Intelligence. Now, this was a week ago. They're still below this 4 level, but they continue to be positive, coming in at 3.81. Then we saw a real pickup with the VIX on a closing basis. We also really picked up and closed not quite at the high, but not too far off of the high when we look at the bar chart. We also saw the volatility of the VIX continue to pick up with the bar chart as well as the line chart. The momentum for the VIX continues to be up as measured by the MACD. We did get an extreme reading already with the VIX when we measure this using an RSI based on 9 periods. And then looking at seasonality here, where we sometimes right about now is where we see a bottom for the VIX, and then it can often go up after that. The SKU index is just coming back up into the red area again. So that's just a little bit of a concern here. The market, that may tell us that this move may not necessarily be over. Now, this big move could also be to the upside, but the market is still anticipating some kind of a big move. But this is more negative. When we get a reading above this dashed line, that means there's a lot of fear in the market right now. Even though the VIX has been going up, this correlation between the VIX and the S&P is also going up right now to a pretty high reading. And here's the equity put call charts that haven't been updated. And then looking at the high beta versus low beta ratio, we really came down because it's the high beta stocks. That's great when they're going up and leading the market higher. When we have a down day, that's when we really see this ratio go down. The volatility risk premium also really dropping off with the down day. We're coming right into the top area of this band. And we were pretty much flat with this fear gauge, and we actually declined. No, I shouldn't say that. We ticked up just a little bit after we saw a big decline on Tuesday. It ticked up just a little bit on Wednesday. We're coming down with our risk on to risk off ratio after that had been going up, but we're still pretty much range bound, and we've been in this range for 2024. But this is still looking good for right now. The advanced decline line based on price, it's holding up. It went up just a little bit here. And when we look at this based on volume, also holding up for right now. That's an internal measure in the S&P. Also, we didn't see as many new highs, but we still saw a lot of new highs on Wednesday, and that's turning our 5 period and our 10 period back up. So this is another internal measure that's holding up for the time being. After getting extreme with our short-term advanced decline ratio, we ticked down just a little bit. We're no longer extreme there. But notice how we're still going up with the 39 period advanced decline ratio. And we're no longer extreme here with accumulation distribution. We had been getting an extreme positive reading. We're coming back down to the moving average. Now, the way this is supposed to work is as long as we're above the moving average, we'll stay above this 0 line down below. If we drop below that, that means things are turning even more negative. And this is what I was really picking up on, the chicken money flow. We would have up days, and yet we're still trailing off with this. Now, it's still positive, but the red line still continues to go down, and we're actually dropping a bit below the midpoint with the chicken oscillator. So our smart money indicators are looking a little weaker to this point. But Even though we came down, when we look at the NYSE cumulative advanced decline line, that just came down after really shooting up on Tuesday. We're still looking good here. We came down a little bit, but not very much with our regular NYSE advanced decline line. Also ticked down just a little bit with this other NYSE advanced decline line. So not an awful lot of damage was done this way. When we look at the common stock for the NYSE based on price, we're still breaking out above this previous high, and we're continuing to break out even though we pulled back when we look at this based on volume. When we look at the S&P, still breaking out based on price and volume, even though it looks like volume ticked down a little bit where price really didn't show much of a change. And this is where we're seeing some of this shift. We're seeing the red line going up as the NYSE advanced decline line is actually improving when compared to the S&P. And we're still holding up okay here with our advanced decline line studies. We came down with the common stock, but still well above the moving average. We were flat with the S&P, declined a little bit with the mid caps, and we were flat with the small caps. But all of the indexes are still above their moving averages. Here's our short-term chart, and we came down. It's probably really hard to see here, but there's a pivot point here, which was also acting as support. And so far, we're going to be watching that to see if this continues to hold. On the bottom, you see where we did go up above average with volume. We maybe overdid it on a one-day basis. We saw a really big downward move on the change from Tuesday to Wednesday, and we're already getting an extreme negative reading. Now, sometimes this can mark some kind of a bottom here. Other times, things might just slow down for a little bit. Here's the Stochc RSI, which is already extreme negative. We have our stochastics in the short term coming down and no longer extreme. Still extreme, but declining in the intermediate term. Also declining, but extreme in the long term. And we fell below the blue and the green line here with our 20-period double and triple exponential moving average study. That, we need to get that back. We're going to stay more positive according to this chart. The fact that we closed below it is a concern. We're still extreme with our 20-period exponential moving average measuring on the S&P 500. We turned down just a little bit after really improving with the 50, and we're continuing to go up, but we're not quite extreme with the 200. The force index, there was enough of a downward move where we actually dropped below zero. So that's turned negative. And we look at our 20-period moving averages. Yeah, there's a gap down here, but we're still above these moving averages, and the moving averages continue to go up. We're no longer extreme with the standard deviations chart. We're right on the border between the +1 and +2 channel. And we're no longer extreme with the boom indicator. Based on 20 periods, based on 50 periods, we did decline based on the 200 periods. And then the balance of power declined, but it's still positive. We're still looking, well, we're changing over to a lighter shade of blue here. When we look at the go, no-go system, the highest high value did decline, but we're still above an advancing midpoint. The TTM squeeze, which had been looking a little bit better, turning to the lighter shade of blue. Now it's turning to the darker shade of blue. In our 50-period moving average study, the double and triple exponential, we're coming down, but we're still above the blue line. And the red line is still above the blue line. So not a lot of damage has been done, at least yet. The ease of movement did decline, but is still above zero. The Erin still looking positive overall. We came down with the S&P McClellan oscillator, but we're still extreme positive. So when we're above zero, that means the summation index based on price and volume continued to go up. We were barely extreme positive with the NYSE McClellan oscillator, but we've since pulled back from there, but we're still positive. So we're going up with the summation index based on price and volume. We're still extreme positive with the Swenlin trading oscillator based on price, but we've now started to turn down with the Swenlin trading oscillator based on volume, but they're still both positive for the time being. Momentum still looking positive here with the PMO, but we're above this red line, meaning we're still extreme positive, and we continue to go up based on price as well as volume. We're no longer extreme with the PMOs that are rising, but we're still going up with the buy signals, and we're still going up with the PMOs that are above zero. And we've gone from being positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. This was a pretty significant drop. Now, if we see more weakness, we might end up seeing a dot come around and be put on top. That would turn this chart negative. And then the slope oscillator, still above its moving average, but still giving us an extreme reading. The MACD, which is a little bit more responsive to this move, it's coming back down to its moving average, but overall the MACD has been going up. So we're still hanging in there with the slope. We're starting to turn a little more negative with the TSI, rolling over a bit with the MACD, PMO, and PPO, but haven't dropped below the moving averages yet. Really didn't pick this up with the tricks in KST, and they're still looking more positive longer term. We're still above all these moving averages here. We haven't broke that support level at least yet. And the bullish percent index, it ticked down a little bit, but it has been showing some improvement lately. We are still looking good here with the NYSE bullish percent index, even on a down day like we saw. But we have now turned negative with the NASDAQ 100 bullish percent index by dropping below 50. The money flow did decline, but is still above 50. The ultimate oscillator has turned negative now and has dropped below 50. The vortex, it's positive with the green line on top, but now the green line's back to declining. We're no longer extreme with the RSI 14, that's the intermediate term, or the RSI 9, that's the short term. We came down with unbalanced volume, but we're still above an advancing moving average. And we're just barely extreme here with those stocks inside the S&P above their 20-period moving averages. So we're still looking okay here with this 20-period moving average study. I mean, even when we saw this real nice up move before, it did give some of that back before the S&P eventually went higher. Not saying that's what will happen this time. We're just kind of using what happened a little over a year ago to kind of model on what might be happening in a similar sense right now. And we just ticked down barely with those stocks above their 50-period moving average. So not really a lot of damage done there. We ticked down a little bit with the 100, and we're actually still going up and looking extreme with the 200-period moving average study. So you can see where not a lot of damage has been done, at least yet. The copy curve continues to be positive. The the Sean trend meter is no longer extreme positive. We're coming down with the rate of change based on 50 periods. After we had been above this red line, we've now dropped below that. So we're no longer extreme. We're still looking good here. You see this 5-period moving average of the highs minus the lows? Man, it's just really continuing to look better when we look at the broad market. And we're still well above this R2 level when we look at the S&P 500 weekly chart. And we came back up here and we got kind of into this 61.8% fib extension area, and now we have fallen back down. We're seeing a mixed picture here with our different trend charts here. The Heiken Ashi is looking a little more negative with the black candle. We're turning down, but still positive with the Kegi. The Renko still thinks we're partying on here and looking positive. And the 3-line break is still looking positive, at least for right now. In the long term, we rolled over a little bit with the 150 and 200, but we're still looking extreme positive. And we've turned negative with the NASDAQ 100 in the short term, but all the other indexes on all the different time frames still remain positive. This is the same too. Long term, based on the price of bonds, we're still negative. We're also negative with commodities. In the short term, we're negative with the US dollar in the short and intermediate term. Still no changes here with the decision point scorecard. And we saw an awful lot. This was like Christmas here. We saw some positive things, some negative things. So it was like red, green, eh? All over the place here. And the sector that got hit the most was tech. And that's been the real darling sector, where there were sectors that actually ended up being positive on the day. Discretionary, that's another area that we want to see doing better. It was down. And communication. These are the three big growth areas. And then we're still looking good here. We declined, but we're looking good with the raw score when we look at the new highs minus the new lows on the NYSE. The equal weight is still hanging in there when compared to the S&P. So we continue to go down with this ratio. That just means the equal weight is outperforming the weighted S&P 500. The Dow was up, setting another new all-time high. How's that? We're still in a positive trend with the diamonds. We dropped below this R1 pivot point. That's a bit of a concern here for the NASDAQ. We also dropped below this R1 pivot level for the NASDAQ 100, but we're still above the 50-day moving average. With the Qs, we've switched from being neutral over to negative with the Elder's Impulse system. The NASDAQ 100 momentum is even turning more negative now. And the Qs, after coming up to this 50% fib extension point, we have now dropped down. We've even dropped below this 38.2 extension level. This is another thing, and I was pointing this out as I was doing market updates on the website. We opened and fell below the 20-period moving average with the Qs. They didn't even give a try of coming back to this. We just kept going down, and we pretty much closed at the bottom there. The small caps, after just shooting up, ended up being down a little more than 0.5%, even though they opened up. Now, this is kind of a scary bar. It saw its highs earlier in the day, and then we closed more closer to the low. But we're still positive when we look at the Elder's Impulse system for the small caps. But you can see we opened and closed just about at the same point. They started off negative and then shot positive, because that's the cool thing to do right now, only to see a lot of those gains get back during the day. And we're still extreme with the RSI when we look at the Russell 2000 small caps coming down and giving us still an extreme reading, coming down with the bar chart itself, but we're still above the 50-day moving average, and the momentum is still positive. And when we look at the ratio from small caps to the S&P, they're continuing to improve, but they still have not broken out above this 200-day moving average with this ratio. We want to see this really turn and show sustained upward movement to turn more positive with this ratio. The mid caps gave back 1.43%, but still above the R2 pivot level. But we're still positive when we look at the Elder's Impulse system for the mid caps, coming off of setting a new all-time high, but down 1.4% in Wednesday's session with the total U.S. stock ETF. Apple was down 2.53%. That is what really helped the S&P and the NASDAQ 100 to go down. We're also down 3.14% now with Tesla. That was another drag, also on discretionary. We're coming back down to the moving average, down over 6.62% for NVIDIA, but we'll see if this support level can hold along its 50-day moving average. Microsoft was down 1.33%, still a little bit above its 50-day moving average. Meta was down over 5%, dropping below its 50-day moving average. Amazon was also down, even though it was Prime Day and all that. It was still down 2.64%. And Google was down 1.58%, but still above its 50-day moving average. So when you take all these big honking companies together, and they all have significant down days, that's why we see the S&P and the NASDAQ 100 really declining. Netflix was also down, dealing with its 50-day moving average. It ended up being down 1.35%. The FANG index really dropped off 3.27%. The financial sector was up 0.75%, still looking solid there. The staples to tech ratio, it is shooting back up a little bit. We'll wait to see, is this going to continue to go up, or are we going to hit this moving average and then turn and go back down? The dollar ended up being down, and it's in a downtrend, at least in the short term for right now. But this longer term trend, which is an uptrend, is still intact. And we look at the correlation between the S&P and the world index, where we're trailing off a bit with the 10 period. That's the short-term correlation, but the longer-term 50-period correlation continues to decline. Looking at the staples sector, they were up 1.29% and well above their moving average. Utilities were also, well, virtually unchanged, but up slightly, dealing with their 50-day moving average. Real estate was up 0.85%. So you can see the market didn't fall apart everywhere. It was the mega caps and semiconductors. Healthcare was also up 0.46%. That's a more defensive area as well. And energy was up 1%. And the bank ETF was up 0.9%. That's still looking solid there. When we look at the financials to S&P ratio, are showing an improvement, but we're still working off of a recent death cross here with this ratio. And we look at the regional banking ETF compared to the financial sector, this is holding up okay. The regional banks are doing better, but we need to see more follow through with this. We did decline with the 10-year yield, so we were up with the 10-year based on price. And then looking at our growth of, and I took out all the ratios from the indexes to the bonds, because we need to have this sorted out before we really try to conclude what's going on here. And we're wondering if, is this just a short-term pullback, which is what it looks like right now. But if we actually start to shift the climate then we're going to be using those charts and looking for slightly different things. But our growth to value ratios are just getting hammered right now. When we look at the Qs to S&P, discretionary to S&P ticked down a little bit. That one's holding up where it's been the disappointing one in 2024. And we really trailed off when we look at large cap growth versus large cap value. So with the large caps, we're declining, mid caps and small caps when you look at growth versus value there. We're still looking pretty good, even though we came back down with our 19-day advanced decline ratio based on price, also declined, but still looking okay based on volume. The S&P to utilities ratio did tick down a little bit, but we're still going up overall. Not a lot of damage was done here. We're still declining with the 2-year Treasury yield, so that could still give some support to the S&P. And we ticked up here, but we have been declining overall when we look at the Staples to S&P 500 ratio. And then we're still waiting to see. We have not received a confirmation yet from the Hindenburg Omen. Now, remember, like this chart right here, it's from Monday. And so we're always one day behind with this. And since Wednesday was such a big day, we'll have to see. Are we going to get a confirmation from this? If that's true, then we're going to need to respect that, because look at other times when we saw a confirmation for the S&P. But we're not as concerned here when we look at the NASDAQ, because we were getting confirmations all over the place as the NASDAQ just kept going up. And even if we see a confirmation here, it doesn't mean we're going to go down. The perma bears are going to think so. They're going to declare the end of the world, but they're going to do that anyway, even if we're setting all-time highs. But we just want to respect what we're seeing here. So what's our outlook for Thursday? We're still positive. And the mega caps and the semiconductors, they're under pressure. Is that a one-day event, or is this the start of something? And so far, to this point, it looks like it's just a pullback. We're going to get the weekly jobless claims and continuing claims. We're going to get the leading economic index. And then we want to keep an eye on all the crazy things happening geopolitically. We're not going to have any economic reports on Friday, at least according to what I could find. And this is also what we're seeing on our other economic calendar. But we're looking pretty good from a seasonal perspective, but we were also looking good for Wednesday. We're up 76.2% of the time for the Dow, S&P, and NASDAQ. So that's looking positive there. We are in options expiration, so we're up a little bit more than down during this week. And we do see a little bit of positive seasonality here for the 18th, but then we see a drop-off here for the next day. And Fridays, I just took a peek ahead. Friday seasonality is pretty stinking negative, and that's also going to be options expiration. And Thursday is one of the more positive days of the week, where Wednesday is the most negative day of the week. And we just want to keep a perspective here with this longer-term trend, according to Carson. We're also wondering, okay, are we beyond this second Christmas time now when it comes to the NASDAQ in early July? And we also see a lot more choppiness when there is a presidential election during July and August. And we're still kind of far away here. We probably have come down just a little bit, but we're still far away from these averages of what we typically see seasonally. We're out of the first half of July right now. Now we're coming more into the second part. And here's a new chart put out by Carson, where this is what we've been doing so far. And it's so far above what the historical norm is, or the average. Are we going to see some kind of a decline to come back down to the average? Look at this kind of like you would the boom indicator. So what are the warning signs? We're just keeping an area on these defensive sectors for right now. The growth to value and discretionary to staples ratios, they were looking better, but not after Wednesday, and not really very much after Tuesday either. Will the mega caps and semis selling continue? And that shouldn't be semi-selling, that should be semis for semiconductors. And the Chaikin oscillators now turn negative. The ultimate oscillator is negative, and we're negative with the NASDAQ 100 on a momentum basis as measured by the PPO, and the bullish percent index has dropped below 50. We're still looking okay here with accumulation distribution, but it is declining, and we're getting close to that moving average again. The Chaikin money flow is declining, even though it's still positive for right now. The parabolic SAR for the time being is still positive. The S&P and NYSE McClellan oscillators and summation indexes continue to be positive. The bullish percent index holding up for right now. The Swenlin trading oscillator also is positive for the time being. I don't know about the equity put call ratios. The advanced decline lines, they didn't really show too much weakness. Our oscillators are still looking fairly positive for the time being. The Copic curve is positive, and all of the moving averages that we look at with the 200 was actually up. And the money flow is positive, the vortex is positive, and the bullish percent index for the NYSE is still positive. And the financial sector is still looking pretty solid there. So our conclusion, we're still positive for right now, but we need to keep an eye on things. Are we going to see more pressure with the mega caps and the semiconductors? At this point, it's still only a pullback, and we're still above the 20-period moving average, which is my definition of the short-term trend. So we're no longer as extreme as we were, but we're still looking positive in the short term. Also not as extreme in the intermediate term. We're still positive there for right now, and we're still looking positive with the long term. So thank you. I really hope you have a good day, and I will talk to you in the next video.